This is the third session of MMPF003 on the subject management control systems. Today we are going to cover 3 units of block 2, that is profit centers, unit number 6, unit number 7, investment centers, and unit number 8, transfer pricing. Friends, till 15th of October, we have covered block 1 and block 2 in part. In block 1, on the topic management control concepts and contests, we have covered unit number 1, management control systems and introduction. Unit number 2, strategies and management control. And unit number 3, designing management control systems. In block 2, it was partly we have completed on the topic management control structure. We have covered unit number 4 on the responsibility centers and unit number 5, cost centers. Today we are going to start with unit number 6, that is chapter number 6, profit centers. Friends, profit center is a responsibility center in which financial performance is measured in terms of profit, which is the difference between the revenues and the cost or expenses. Profit as a measure of performance is considered more useful since it is one comprehensive measure that dispenses with the need to use several measures, e.g. profit margin, asset turnover, etc. See, profit is the most widely used measure of performance for a business firm. Profit means your good work is coming up, and hence therefore not surprising that profit centers are popular amongst the large decentralized organizations. In general, a profit center to be truly called as such is the one that is selling a majority of its output to outside customers and is free to choose sources of supply for a majority of its material, goods, parts, components, services, etc. That means two-way. If they are having the autonomy about the selling part, they are having the autonomy about choosing the sources of supply for its material, goods, parts, components, and services, etc. A question may often arise whether a company should treat a segment as a profit or as an investment center. Now, there is a small catch. In fact, a business enterprise may have the choice to establish a segment either a profit center or as an investment center. In an investment center, the manager has the added responsibility for a return on assets used in his or her center. Let us just look at the corporate philosophy, style, and profit center autonomy. The corporate philosophy, style, and profit center autonomy. What is autonomy? Autonomy is a dynamic concept and may not be the same for all the things, for all the times. Okay? Autonomy is a dynamic concept and may not be the same for all the times. Okay? Further, the autonomy of one manager may be different from the other in terms of quantity and quality. Very simple difference between the HR and the marketing manager or the production manager. Even though they are managing similar kinds of units, corporate management influences profit center managers through a network of relationship that lay down the domain in which the manager has the freedom to take whatever action he or she deems fit or appropriate in regard to the responsibilities that are placed or expected of him or her. Okay. There is a difference between the intended autonomy and perceived autonomy. Intended autonomy and perceived autonomy. Intended autonomy, friends, of managers is what is formally contemplated or provided for by the organization through its structure, policies, and processes. But perceived autonomy is what a matter of fact is perceived to actually exist by a manager. If intended autonomy can be regarded as the theoretical part, then perceived autonomy can be considered as the actual or practical autonomy. And the two types of autonomy may be found at variance with each other in real practice. It is the corporate philosophy that influences the vision and mission of the organization. Friends, corporate philosophy affects the strategy and the management style. What responsibility structure or simply the structure, policies or procedure the company will have are largely determined by the strategy of the organization and the management style of the corporate or top management. Whether there will be centralization or decentralization of decision making is largely influenced by the corporate management style, which may be either autocratic or democratic. Friends, the managerial style consists of several personal variables that influence the behavior of corporate management. These variables include the desire of the corporate manager to be involved in the details of the business of the unit and their day-to-day interaction with profit center managers, and the level of trust and confidence the corporate management has in the ability and experience of managers. Let us now look at the diversification and decentralization. Friends, autonomy is coextensive with the strategy of diversification. That is, more the enterprise diversified, more the autonomy its unit tend to have. One of the purposes of decentralization is the economic efficiency, which means utilization of resources to achieve the maximum possible benefits. If a segment is to be economically efficient, it should follow the same pattern of behavior that are found in independent entities competing each other. When profit responsibility which otherwise exists at the corporate or highest level percolates down to the business unit or divisional level, the process is known as profit decentralization. Let us look at the benefits and limitations of profit decentralization. An organization can reap several benefits from profit decentralization. But profit decentralization may also give rise to several difficulties. If there is some kind of pluses we may have certain minuses also. That is the difficulties, which the management has to resolve before they crop up. Some precaution we have to take. It is in this context, the proper design of profit center structure is of paramount importance. Benefits of profit decentralization. The following benefits are usually claimed when profit responsibility is delegated among profit lines to the units of the enterprise called profit centers. Amongst the benefits, we may have the better understanding about firm's ultimate objectives, the vision and mission. Better profit planning. You can have a profit planning in a better way. Better morale and motivation, because see, once you are having the profit planning, that means your morale and motivations are up. Better quality of managerial decision, because you have many things in a planned way. You are motivated and you have the better understanding of firm's ultimate objectives. More attention by corporate management on strategic aspect. See, the corporate management is now focusing on the strategic aspects as well. The training ground for developing a cadre of general managers is a training ground. And finally, encouraging a spirit of competition. Once you are strong enough, once you are planned enough, once you are motivated enough, once you have the better quality of managerial decision, once you are straight, say, into the strategy also in case of any need, then you have the spirit of competition in the market. Let us just look at what are the difficulties and limitation of profit decentralization, profit centers. Costly form of organization. It is normally said, but then when we look at the benefit part, it gets neutralized. Necessary restraint difficult. Restraint difficulty, you see, if you are invoking the discipline, definitely it comes out to be difficult for people. Friction and dysfunctionality, there are a possibility that there could be some friction because one reason or the other. There could be some dysfunctionality also because of the restraint or the friction they may have. Bickering on transfer pricings. There may be some kind of dislocation of the transfer prices also. And difficulties arising from the common cause. Sometime it may be from the common, anytime. Anything could just happen. An unhealthy competition. Some people say that it is unhealthy competition if you are just, say, competing with some other who are not that well off. See, ultimately, it is the proficiency, it is the resource utilization, it is individual even has to just come up. Unhealthy competition does not mean because the other people are also free enough. Why they are free enough? Because they are also in the competition and they can also just invoke all those provisions. The success story has improved, right? Making success of profit decentralization. For making profit center structure effective and successful, it is necessary that attention is paid to the following points. The first one is minimum interdependence. Independent. Minimum direct competition in outside market. Okay. That may not be possible, but minimum direct competition. That of course is not very possible, but then okay, you have to live with it. It is one of the presumption. Rational transfer pricing system. Rational, that means that when you are just having the transfer pricing system, it should have the rationality, it should have the reasonability. Why you have just given that particular price to your other unit or to your other branch. Non-interference policy. Friends, when you are giving them autonomy and you make them interfering, say, in their work, then definitely the work either would be suffering or the output would be low. So non-interference policy is the ideal thing, that you are just giving them enough autonomy to work according to their plans and the vision and mission the organization has. Finally, emphasis on long-term profitability, because the profit wave should not be like this. It should be the long-term profitability. It should be on the upper side and thereby just giving a sort of growth to the organization. Friends, establishing profit center. When we are just looking at the establishment of profit centers, the profit centers are established as a result of the decision of the top management. That is, profit centers come into being because the top management thinks that it would be a good idea to designate all or some unit of the organization as profit centers. and hence it creates such entities. An efficient profit center should have the following characteristics: operational independence, which I said, minimum interdependence, that means operational independence. The manager should have the control over its operation and be free to make decisions concerning such questions as the volume of production, method of operation, product mix, etc. Access to sources and markets. Autonomy means this: the manager should be free to buy and sell in alternative markets, both inside and outside the company. Where freedom to trade is absent, the buying and selling profit centers managers have little incentive to reach optimal decisions. Again, the interventions are less. If it is, then only the managers will be having the incentive to reach to the optimal decisions. Separable cost and revenues. We must be in know of it, at what level, what cost we are just incurring, and at what level, what revenue we are just earning. The profit center should have cost and revenues that are separable from other segments of the company. It should be able to identify all costs and revenues which are measurable. Management intent, a very important coordinating factor. A profit center should be established only when the overall goal of management is profits for the segment. And the management has the intention to treat the segment this way. Friends, to sum up, the rationale behind the creation of profit center is that the organization will function more efficiently when it is subdivided into a number of independent units which operate as economic entities. Let us now look at the prevalence of profit centers. The profit center system or the profit decentralization has been a key concept in organizing large corporations in the United States, such as General Motors, General Electric, DuPont, etc., where the companies establish separate divisions for each of their major products and product lines. Right? So what we are looking at is the prevalence of profit centers. It is the example they have given of US, where the General Motors, General Electric, DuPont, etc., they have established a separate division for each of their major product or product lines. The clear bifurcation of the cost and the revenue. The idea underlying profit center has been employed by distributive trade, such as departmental or chain stores, which place all the operations in each region on a profit center basis. Let us just look at what is the motivational value of profit centers. From time to time, some writers have made observations supporting the profit center approach, and their main argument has been that profit center idea has a motivational value. That is, if a unit of the company is regarded as a profit center instead of a cost center or revenue center, the manager of such a unit feels that he or she has been given a higher status by the management, and his and her abilities have been recognized. It has also been suggested that the managers at the middle level get more satisfaction from being associated with a subunit called a profit center rather than a cost center, even though they may have no control over the profit they are reporting. Now, the managers, they get more satisfaction if they are called a profit center rather than a cost center, because They feel elevated, they feel motivated, despite being the fact that they don't have any control over the profit they are reporting. It may not. Still, they are elevated, they are motivated, and they are trying hard to take such managerial decisions. Let us now look at the target profit, budgeting, and reports. What is the target profit? Once again, it is a planned profit you have. Once it has been decided that the financial performance of a unit will be measured on a profit center basis, it becomes a regular, periodical, half-yearly or yearly, whatever is decided, exercise to determine the target profit. The profit budgeting center, the means for achieving target profit may involve a number of actions planned. And new initiatives like increased marketing or research budget, higher sales volumes, penetration into new geographic areas, the adding or dropping of products, and other activities which would be the responsibility of the profit center managers. All these activities are translated into a feasible plan whose financial impact is expressed as a projected or budgeted income statement and whose net income is the target profit agreed upon. After the budget expressed as income statement. How to just get the performance appraisal? The performance of the manager in the first instance means his or her financial performance, which would be based on a comparison between the actual profits earned by his or her profit center against the agreed target profit. The actual profit and the agreed target profit of his or her profit center. So there is a comparison. Here the fundamental rule in accordance with the concept of responsibility accounting is that managers should be measured against those items that they can influence. Hence the basis of comparison usually should be either the direct profit or the controllable profit. Okay. Friends, with that we have completed our unit number 6, that is chapter number 6 on the profit center. We are going now to see the investment centers. It is a step ahead, which is just giving you the information about the utilization of the assets or the resources. The investment center is a unit of the organization whose manager is responsible not only for the inputs, operating cost, and outputs, revenues, or for producing a profit, but also for the assets employed. I told you it is the additional responsibility. There is not much difference between the profit center and investment center. A step ahead only. Investment centers, in fact, are profit centers, precisely, with the extended responsibility for effective utilization of investment. That is responsibility for a return. As a matter of fact, all investment centers are profit centers, but all profit centers need not necessarily be investment centers. Because in the investment center, it is a plus of the profit center. In creating or establishing investment centers, the management would be guided by the same set of criteria as was discussed in relation to the profit centers. What are those? Factor to which top management wishes to direct the unit's manager's attention. Factors which can be controlled by the manager of the unit, and education and experience of the typical manager of this type of unit. To be truly called an investment center, The manager, apart from the profit variables, must be able to influence to a fair extent the size of the investment base. The objective of establishing an investment center in a decentralized organization is to provide as an incentive for the unit's division manager to purchase, retain, or retire assets, facilities to maximize the interests of his own unit as well as the organization as a whole. Some important questions that arise in the context of investment centers are: how do we measure the overall performance of an investment center? What method or technique are available for measuring the performance on an investment center? How do we determine the profitability of the investment center? And how do we determine the investment base of an investment centers? Finally, should we make a distinction between the measuring and managerial performance and economic performance of an investment center? And if we do, then how do we accomplish the task? So all these questions are just coming up when we are just thinking about the investment center. Objectives of the investment center. What are the objectives? The basis. We are just establishing the investment centers, or we are giving the added responsibility to the profit center. The objective of the investment center is to make sound investment decisions. That means, in totality, it is concerned with cost, revenue, and the asset utilization factor. Therefore, the objectives of the investment center can be listed as follows: measurement of profit against investment, control on cost, revenue, and asset utilization. Third, deciding the priority of deployment of capital, the novel cause, the novel objective and decision. What are the overall performance measures? How do we just find the overall, apart from profit center, investment center, the overall performance measure? Broadly speaking, there are two ways of relating profit to assets employed or measuring the overall performance of an investment center, namely return on investment ROI and residual income or economic value added EVA, it is called, and residual income is, the abbreviation is RI. When we talk about return on investment, ROI is the ratio of business units' profits to assets employed to earn that profit. The prime concern of an investment center is how efficiently it uses its assets. Profit center measures the profit in absolute terms, whereas investment center measure it in terms of asset utilization efficiency. Both are having different objectives. What about the residual income, RI? Under the residual income method, decisions are charged with an opportunity cost of capital set by the corporate management for the investment deployed in the divisions. Usually, the rate is set somewhat below the company's estimated cost of capital, so that the economic value added of a business unit will be above zero. Friends, residual income is the income made by the division minus the charge for capital. This is the residual income, right? What are the precautions while using ROI? What are the precautions we are to use when we are exercising return on investment method? Even though ROI is very popular measure for measuring the performance of an investment sector, it gives ample scope of manipulations also. Some of these specific instances where ROI could be adjusted by making the accounting adjustments are as discussed below. Expense versus capitalize, leasing of assets. There somewhere or else you can just think of the manipulation part, which we have just seen here as a precaution because it is just giving the ample scope of manipulation also. So these are normally done by making the accounting adjustments. There is a comparative analysis if we are to just look at by ROI and RI, EVA. The significant characteristics of both ROI and RI is that they direct the attention of the investment center manager towards minimizing the investment in the assets relating to net income. If the manager can maintain the net income while reducing the asset investment, ROI will be increased because the denominator of the fraction is made smaller. The RI, however, direct the manager's attention more explicitly to the amount of income earned relative to investment. So this is the broad comparative analysis we have between the ROI and RI. Measuring the investment base. Friends, the choice of investment base for assessing the performance of the investment sector could be tangible or intangible assets, controllable, uncontrollable, and partially controllable assets, total assets or total assets minus liability, etc. Each of these will have the effect of changing the ROI. Similarly, the asset value could be gross block or net block, book value or market value, or replacement value, etc. Asset valuation alternatives. Having explained that what assets should be included or excluded from the computation of investment base, we now take up the second aspect in relation to the determination or defining the investment base. To be more precise, how should the fixed asset be valued for the purpose of determining the investment base? Fixed asset, that is plant and machinery in an area where there are significant measurement difficulties. First is these assets are long-lived. There is a strong likelihood that their economic value may differ significantly from their historical cost as shown in the accounting records. The economic value may differ significantly from their historical record as shown in the accounting records. Replacement cost, the historical versus replacement costs. It is well known that purchasing power of money has been declining over time. The higher the rate of inflation, the lower is the value of money. It has therefore been asserted that performance index would be misleading if the effect of inflation on price level changes is not neutralized. The main reason for the distortion that occurs is that While revenue and costs are measured in current values, the investment and depreciation are measured on the basis of historical cost used to acquire assets. Appraisal of managerial performance. Since investment centers are extension of the idea of profit centers, wherein the managers have an extended or additional responsibility for effective utilization of investment in their centers, the broad approach to performance evaluation, therefore, is similar. We have already discussed that the financial performance of the investment center manager is evaluated in terms of ROI, RI, or EVA, or a combination of these indices as decided upon by the company. Friends, with that, we have also covered the unit number 7, the chapter number 7 on investment center. Now, one of the most crucial thing we are just talking about when we are having more decentralized version of the organization. We have different units, branches. One unit is selling the product. The other unit is manufacturing. Or maybe one unit is manufacturing, the other one is packing, and the third one is selling. So in between, there is a small but important value addition in the price of the product. When it starts from the factory, it is the, say, raw material cost, it is the, say, wages cost, and the prime cost kind of thing. But once we are just going in the administrative and the factory cost, adding to, we just keep on adding the value addition to the product's price. So our transfer pricing is based on that. What is transfer pricing? Multinational enterprises carry on business in more than one country, either directly through branches or indirectly through subsidiaries. Whatever the form, the activities of a multinational enterprise, individual operating units are rarely completely self-sustaining or independent, with the result that transactions takes place between these units. The price of which goods, services, or capital are exchanged between the related parties is known as transfer price. The price at goods, services, or capital are exchanged between the related parties. Exchange between the related parties is known as transfer price. The transfer price is determined by the transfer pricing policies used within the related group. The transfer price received or charged for our goods, services, or financing will be included in the income of supplier, and the corresponding cost or payments will be deducted from the profits of the legal entity benefiting from the transaction and making the payments. What are the motivations for transfer pricing manipulations? People who are not very positive about transfer pricing policies, they call that there is ample scope of manipulation also. But what are the manipulations motivation? Why we are motivated to go for the manipulation or some kind of via media or some kind of, say, alternative means we are just thinking for? Let us just look at it. It is not just the corporate tax differential that induces organization to manipulations in transfer pricing. Some of the other reasons are there. It is not the tax alone, many other things. High custom duty leading to under invoicing of goods. If there is high custom duty, the invoice of the price, say goods, would be under invoicing, lesser than the actual cost. Restriction on profit repatriation leading to an over invoicing of raw material. If suppose you are just restricting your profits, you are increasing, over invoicing the raw material, etc., transfer from parent country, hence compensating for logged forex. Ownership restrictions are insurance sector 26%. Since this leads to less justified returns on the technology or knowledge invested in the JVs, multinational enterprises circumvent it through overcharging on royalties for technology. Friends, there can be various other similar motivation for TPM, but transaction most likely disputed by the government are administration and management fee, royalties for intangibles, and transfer of finished goods for resale. Transfer of finished goods for resale. What are the methods and criteria of transfer pricing? Many enterprises today have decentralized structure with some variation of vertical integration in which the result of one unit becomes the input of the another unit. Transfer price is the financial basis used to quantify the transfer of products and services from one unit to the other. It enables to determine if the participation of each participant in the internal transfer is adequate and correct, as well as to measure its efficiency. Friends, transfer pricing has become a very influential factor of efficient management and is one of the most important elements in performance measurement of decentralized enterprises and its parts. The internal transfer of products or services can impact positively or negatively. I told you. That is why it is called for the incentive for manipulation. The performance measures used for organizational units just the same as the external transfer of products or services. Basically, it should be obvious that a conflict is likely to arise or in an enterprise between its central manager, because the buyer center wants the transfer price to be as low as possible, while the seller center wants the transfer price to be as high as possible. So there is a conflict, there could be a sort of opinion difference, which has the ways and means to sort it. Therefore, an exchange of products or services takes place between a center or an external party. The forces of demand and supply on market determine the price in external transaction. An exchange of product or services between a center or internal party, however, poses a potentially more serious and complex problem than the external exchange. What transfer price should be set so that buying and selling centers acting in their own best interest? Here is a resolution. Will at the same time act in the best interest of the enterprise as a whole? This is a serious question because suboptimal decisions making will result in if either the buying center manager goes to an external supplier to satisfy his needs, when he should have gone to the selling center manager, or the buying center manager goes to the selling center manager to satisfy his needs when he should have gone to the external supplier. So these are the two possibilities. The transfer pricing method used must be the one most beneficial to the enterprise. The end resolution is that it should be beneficial for the enterprises, the organization. The following 4 interrelated criteria should be used to evaluate adequacy of the transfer pricing method that are currently being used by profit or investment sector. Goal congruence. The transfer prices that are set should enable the harmonization of goals of enterprise as a whole and its parties as well, to avoid suboptimal decision making. Motivation. Transfer prices should not interfere with the process wherein the buying center manager rationally strives to minimize his cost and selling center manager rationally strives to maximize his revenues. Autonomy. Each center manager should be free to satisfy his own needs, either internally or externally, at the best possible price. Friends, this also means a higher autonomy of profit or investment center in the enterprise. And fourth, the performance evaluation. Transfer prices should enable objectives evaluation of profit center, results giving the information for optimal decision making, and real appraisal of performance, managerial performance, and economic value of particular parties of the enterprise. In accordance with the criteria, the transfer pricing method should be chosen in the way to be most beneficial for the enterprise as a whole, as well as for its organizational parties as well. Categories of intercompany transfers. There are various forms of intercompany transaction. Transfer of tangible property or intangible property, the provision of services and finance, rental or leasing arrangement. Now, to determine whether an intra-company transfer has occurred or not, the substance and situation of the transaction will determine whether or not the transaction has taken place, rather than whether an invoice is rendered universally. The basis for determining consideration for intra-company transactions in the arm's length principle. Sale of tangible property. Definition. Tangible properties are the physical assets of a business. Tangible assets can further be classified as current assets, current tangible assets, fixed tangible assets. Types of intangibles. The term intangible property includes right to use industrial assets such as patents, trademarks, trade names, designs, or models. It also includes the literary or artistic property rights and intellectual property such as know-how and trade secrets. These intangibles are the assets that may have the considerable value, even though they may not have a no book value in the company's balance sheet. There is also maybe considerable risk associated with them: contract, product liability, or environmental damages. Modes of transfer of intangibles. There are 4 broad ways which intangibles can be transferred between the related entities: outright sale for consideration, outright transfer for no remuneration, that is by way of gift, license in exchange for a royalty, royalty-free license. As a general rule, number 2, 4 transfer without remuneration are not accepted by the tax authorities of any country, except for the limited contest of property owned and exploited from tax havens or business reorganization. Method number 1 and 3 are commonly used and are primary method of transfer of intangibles. The arm's length principle. The basic premise of arm's length principle is the compensation consideration for any intercompany transaction shall conform to the level that would have applied the transaction taken place between the unrelated parties. All other factors remaining the same. Factors ways in the determination of arm's length prices are the type of transaction under review, the economic and commercial factors underlying the transaction, the form of payment, either lump sum payment or a stream of royalty payment spread over the predetermined period. What are the application of arm's length principle? There are a number of methods which, when applied currently, can determine the arm's length price. These methods are also known as the recommended methods. These methods are divided into two groups. The first one is traditional transaction method, the comparable uncontrolled price CUP method, the resale price method, and the cost plus method. There is another method, the transactional profit methods, the profit split method, and the transactional net margin method, TNMM. Friends, with that we have covered the unit number 6, 7, and 8 of block 2. This was the third session of MMPF003. I convey my heartfelt thanks to the COE and the Regional Center Noida for arranging the beautiful systems and procedure for dissemination of MMPF 003 of management program. Thank you so much. Namaskar.